So it's normal for you to doubt yourself. It's normal for you to feel like you don't have it all together. And what if you can't do it? That's normal. That's normal thoughts. What if you do far fucking better than you ever thought you could? I'm not fearful of this thing. I'm not fearful of never getting where I want to be. I know I'm getting there. I'm not stopping, so therefore I'm getting there. I might be delayed in my arrival, but I'm going to show the fuck up when I get there. You're speaking against your adversities.
Alright, bet. Today we're going to be doing a trade analysis for the 10th of April, being a Friday. And we're going to take a look at the 3 trades I took during Friday's price action. So I took 2 trades during the AM session and 1 trade during the PM session. So as per usual, we're just going to jump into the higher time frames to get a grasp of what is going on overall. So when we take a look at the daily on NASDAQ, we have Friday's trading right here, and we have the previous day being Thursday. Now, I had a trade analysis for the trade I took on Thursday, and at the end of the video, I stated that, okay, we have a potential for a TGIF setup going into Friday, and we may end up seeing the previous month high being faded, and we may see a return back down into the 0.2, 0.3% of the weekly range. Now, the conditions to permit for a TGIF setup entails Monday, Tuesday, Wednesday, and Thursday's price action, all delivering in one direction, which is what we have overall with this week. We have Monday buy side delivery, we have Tuesday buy side delivery, Wednesday buy side delivery, and Thursday buy side delivery, all being up close candles. And with the premise of TGIF, what you'd be looking to see is price action returning back down into the 0.2, 0.3% of that range, and this would be referred to as your TGIF. Now, when you anchored the Fibonacci, so from the Tuesday, the low of the week, all the way up to Thursday high, we have the 0.2, 0.3% projecting for the low of the daily SIBI, which is very nice because a daily PD array is in alignment with where we're looking for that Friday retracement. Now, I stated that we may end up seeing the previous month high being faded, and that is what we did do. We didn't engage with the previous month high. I wouldn't say fade entirely because we did have that buy side deliverance towards the previous month high, but we didn't engage with it on Friday's price action. Observing this price action, you'd be seeing that, you'd be acknowledging the fact that, okay, we're having, continuous buy side delivery. We're eager to get somewhere, being this TLP as well as the previous month high. You'd expect for Friday being CPI as well, that injection of volatility to take us up to that previous month high. But that is not what we end up seeing. We end up falling short of it, but we also don't end up seeing the NASDAQ engaging with our TGIF. But when we take a look at YM being a correlated asset, so taking a look at YM here, and if we project the exact same TGIF range, so Monday being the low of the week all the way up to Thursday, YM does engage with the 0.2 to 0.3%, and you can deem that a cracking correlation. The only problem is the fact that, well, not necessarily a problem. The only fact of the matter is that YM didn't engage with the previous day's low, which would be the respective daily BISI high. But for the daily, that there wasn't really much in terms of what we were looking at, simply just observing, okay, we have the previous month high above us, and then we have the TGIF being that 0.2, 0.3%, which the high of the daily BISI resides. And then taking a look at the hour 4, there also wasn't much that I was paying attention to on the hour 4, to be honest. Very lethargic price action. We're not showing a willingness to, continue this buy side delivery motion as we have been doing over the course of the week and past week and a half, X, Y, and Z. But when we are paying attention to the hour 4, we see that we came and engaged with the -2, -2.5 of this standard deviation. So from this low all the way up to this high, projecting up for buy side, we have the -2, -2.5 projecting for the previous month high. We end up engaging with the -2 level, and this is where we end up forming our high of the day. And then we take a look at the hour 1. So in relation to the hour 1, we're actually going to start right here. So this candle, 1400 candle, is where I went long during the Thursday's price action. And this candle would be deemed an order block. Reason why being is because we see this candle delivering into this imbalance right here. So the bullish imbalance that resides here, we have that deliverance into it. And then we have the next candle closing above this 1400 candle, giving us the formation of an order block. And what we end up seeing is that later on in time, this order block is being utilized in a very efficient manner in terms of the mean threshold threshold being utilized as support for price action to continue that buy side delivery motion. So if we zoom in just a little bit, we see price action opening up on the 1800 candle here, and we come and engage with the mean threshold. Next candle, engagement with the mean threshold, but bodies once again being very respective. We're not seeing any body closure below the mean threshold of the order block. And then we have that deliverance and consolidation for the Asia session, and then we return back down to this hour one order block, engaging with the mean threshold again. And this is where we have that London low forming for that buy side delivery. So London forms its low at the mean threshold of this order block from Thursday's price action, and then buy side delivery is followed right after. So that is quite it for the hour one. There wasn't really much that I was paying attention to in regards to the hour one. When we take a look at the 15-minute, price action is a little bit more descriptive as in terms of what it's doing. So when we are taking a look at the 15-minute chart, we have the 1800 opening residing right here, and we see it's not really much price action going on. We have that deliverance up towards buy side during the Asia session, and then we have Asia collapsing right here. We have our midnight opening that resides right here on this candle, and then we end up seeing that deliverance down towards sell side. So what we take a notice to is the fact that midnight opening, we have no high that formed above it. So midnight opens and we immediately deliver straight down towards sell side, and we know that midnight opening is a very key time opening, and anything above it you deem a premium, anything below it you deem a discount, and you look at the midnight opening as its own being a form of equilibrium. And what we end up doing is we immediately deliver down towards sell side and we don't form a high. And the reason why it's important that we don't form a high is because with the midnight opening, we essentially have two openings for a daily candle. You have your 1800 opening, which is your settlement opening price, and then you have your midnight opening, which is your IPDA opening price. And both of these key time openings have their own power of three. They have their own respective power of three that needs to be delivered during the course of that day's price action. So that instantaneous deliverance down towards sell side, and then we have that London session, as we know, forming its low at that hour one order block at the mean threshold, and we end up seeing a Kraken correlation presenting itself right here for that buy side delivery motion. So Kraken correlation at that hour one order block that resides just right here during the London session. And then we have the change in stay in delivery and then utilization of this order block to continue that buy side delivery motion. And you also have that standard deviation projecting from the low to the high of this leg, and this would be your London standard deviation projection. So we see the -2, -2.5 projecting for this high, so just above the midnight opening, and then we have the -4, -4.5 projecting for something on the left side of the curve that we can't see on the 15-minute. But this is where we end up seeing price action come to a halt ahead of our high impact news event being CPI. In fact, I'm not actually sure if I mentioned this, but in relation to the economic calendar, the high impact news event that we had for Friday was CPI. So getting that out of the way. So we had CPI on the Friday. So we have the standard deviation projection -2, -2.5, -4, -4.5. As we know, this is where terminus is, and where terminus is, another point of inception can occur. So market maker buy model, terminus, market maker sell model. So we end up having 8:30 opening up right here, and it's rather after the 8:30 opening we have very poor price action. So if we simply just pay attention to the bodies, we're not doing anything. The wicks are simply doing the damage. The wicks are sending people one way at one point, the next way at another point, simply just going back and forth, back and forth, back and forth. And then we end up having this deliverance up towards the buy side, engaging with this high. And this is where the point of inception was for the short that I took during the AM session. And then for the long position that we ended up taking, the long position resided just right here. Now, in relation to the standard deviation that I have projected out in price, I have a standard deviation projected from this high all the way down to this low, projecting for a -2, -2.5, which is projecting for the range high that we were taking a look at from Thursday's price action. And then we have the -4, -4.5 projecting for the range low. As we know, the range low is never engaged with. But we don't end up seeing this standard deviation being exhausted. And the current stance of what price action is doing, we've retraced back into this order block. Now, I'm not sure if price action is going to utilize this to continue down towards sell side over the course of next week, or if we're simply just going to invalidate this point of inception entirely and then engage with that previous month high and then return back down into the range. But this is a very over exaggerated standard deviation, and in terms of coming to a conclusion that a standard deviation is over exaggerated. Experience is quite literally all that is required in terms of projecting standard deviations on a daily basis, continuously, over and over again, consistently. You'll come to learn and you'll come to see that certain standard deviations, yes, as they may be delivered to, they may be very over exaggerated for what we have within the day's range, because we know that the day only has so much juice. There's only so much of a range that a day can deliver. And when we observe what a day has done, so the time this standard deviation was confirmed would have been 11:30. Already we know that we're rolling into the lunch session. We know that lunch is utilized for consolidation. Of course, there are circumstances where lunch can be utilized for an expansion, but certain conditions have to be set in place in order for lunch to be utilized for an expansion. And in relation for lunch to be utilized for an expansion here, you would have wanted to see price action reaccumulate orders inside of this M15 SIBI as well as this order block during the lunch session, so that we could end up seeing maybe an expansion halfway through lunch towards sell side. But we don't end up seeing that occurring. We simply continue this sell side delivery motion. So in circumstances like this, you have a standard deviation projected out on price and you're utilizing the wicks, and it looks quite far of a range. There is always another option, being anchoring a standard deviation to the bodies. So when we anchor a standard deviation to the bodies, what we end up taking a notice to is the fact that we end up engaging with the -2, -2.5 standard deviation. And this is where we end up having the reaccumulation of orders for price action to end up returning back around. And this is where we also have that cracking correlation, which is the lunch low right here. But we'll see it a lot clearer once we get to the lower time frames. Now, if there is a lack of experience to determine whether a standard deviation is over exaggerated, another means that can be done is simply observing what price action is done. Now, we're going to paint out what we'd look to see in an ideal world. So in an ideal world, when we are projecting a market maker sell model, so we're looking for a point of inception to occur at buy side and we're looking for that deliverance down towards sell side, what you'd like to see is a manipulation leg, and then you'd want to see your change in stay in delivery, and then you'd also want to see a standard deviation in which you can anchor from that manipulation leg. Now, within this manipulation leg, in an ideal world, what we're going to see is a series of up close candles and a series of down close candles for that change in stay in delivery, for the formation of the order block. But more importantly, the engagement with the high for the manipulation, we would like to see that be a bullish candle. If it's not a bullish candle, it's not necessarily a bad sign. It's not something where it's like, okay, the setup is going to fail or anything. But in an ideal world, we'd like to see a bullish candle. Now, when we take a look at this price action right here, we're looking for price action to form a point of inception right here for a market maker sell model. And what we take notice to is that the candle that ended up engaging with buy side closed bearish. Now, like I mentioned, this isn't the end of the world. It's not to say that the setup is going to fail, X, Y, and Z. On lower fractals, it may present a bullish candle, but when we're observing this 15-minute time frame right now, it's a bearish candle that ended up occurring right here. And during my time of exploring the means and methods of the way I'm looking to engage with price action, I always found it a bit concerning as to when I'm engaging with price action, looking to form a point of inception, and I'm looking to anchor a standard deviation onto the manipulation leg, and the candle that engaged with the pool of liquidity, in this case buy side, closed bearish when I'm looking for it to close bullish. I often found that when I'm anchoring these standard deviations from that leg, so from this high down to this low, the standard deviation wouldn't be exhausted, and this led me to questioning as to why. There has to be something else that I'm not seeing in terms of, okay, why is the standard deviation from the high to the low not being exhausted? Is there another standard deviation that I can project? Because there's a lot of ways that you can anchor a standard deviation to project for a buy side or sell side delivery. In relation to a point of inception, you're always anchoring the manipulation leg. But anchoring it to the bodies, you're essentially only anchoring it to the up close candles, because this would be manipulation. It's delivering towards the opposite direction that we're looking for price action to deliver towards. So we're deeming that range manipulation, and we're anchoring it to the bodies because we associate smart money with bodies. The bodies are going to tell the story of what is going on. The bodies are going to tell the underlying story of what price action is trying to do. The bodies are going to tell the underlying story of what the motives smart money are trying to accomplish, X, Y, and Z. So anchoring it to the bodies of the up close candles ends up projecting a more fractalized, more refined standard deviation in price. And what we take notice to also is the fact that, okay, we have our -2, -2.5, which is where we end up having that reaccumulation of orders in the same fashion we'd see if we're anchoring it to the wicks. We have that cracking correlation and a point of inception occurring right here as well. But we also have the -4, -4.5 residing inside of the -2, -2.5 of the wick standard deviation. Now, this isn't random. This is just algorithmic because I've said this before, the standard deviations speak the language of the algorithm. When you think of an algorithm, there's maths involved behind an algorithm. When you think of a standard deviation, for one, it's a Fibonacci tool, and there's maths behind Fibonacci. It only makes sense for the standard deviations or the Fibonacci tools to align with whatever the algorithm, if used correctly, to align with whatever the algorithm is laying out in price. It's the same way during the Thursday analysis that we were doing. We ended up seeing that this range right here that we projected out in price, so this range high, range low, we have the equilibrium, aligns with our midnight opening. This is algorithmic. This range printed before our midnight opening even. This range printed before midnight opening even opened. So it's simply just algorithmic, and it's a completely different Fibonacci setting. This is simply just looking at premium and a discount, but I think I've gone on a very long tangent here, but simply just using the bodies in terms of when a standard deviation seems to be exhausted. And another point in which we look to use the bodies is if there is no swing high or swing low. And a perfect example is right here where we have that -2, -2.5. We end up having a swing low, but there's no swing high in this sequence of price action right here. There's no swing high. And like I mentioned during my time in terms of finding a means and a method of looking to engage with price action, when I'm looking for a point of inception, we're looking for that swing high to swing low or swing low to swing high formation to anchor a standard deviation to project out in price. This only has a swing low. There is no swing high. The next swing high would be all the way up here, over exaggerated. Another problem would be the fact that it's not change in stay in delivery. We want to anchor the standard deviation onto a change in stay in delivery because we're aligning our standard deviations with the market maker models. When we're anchoring our standard deviations at a point of inception, what we're actually projecting out in price is the caps for where the market maker model is going to either have a point of reaccumulation, redistribution, or smart money reversal, or where the market maker model is inevitably just going to collapse, being terminus. So in this case, instead of anchoring all the way up here, we're going to anchor it to the bodies. And the standard deviation would look like this. And this is where we end up seeing price action collapsing for the day. Once again, this isn't random. This is simply just algorithmic. Now, finally, taking a look at the price action on a lower time frame, observing the M1 chart. So we have very poor price action during the AM session. As you can see, 15-minute looks poor. You know the M1 is going to look just as poor as well, being very wicky price action. When you're engaging with price action, you don't want to see wicks. Well, you're going to see wicks. You don't want to see a lot of wicks. You don't want to see more wicks than bodies because it means price action is very indecisive. It doesn't know what it wants to do essentially. Compared to this move that we have here, we're seeing bodies. We're showing willingness to go somewhere. When we're seeing wicks, it's not nice. For instance, if we simply just remove the wicks, it makes it a lot more clear as to what price action is doing in a sense. It's, you know, you can see clear consolidation, and then you can see the points of inception or the points of deliverance are very meaningful in a sense. Here we have a point of inception for that buy side deliverance. You can see the candles are filled with volume. Here we have a point of inception. We can see that the candles are filled with volume. So that is essentially what we are paying attention to. But very poor price action during the AM session. So going over, we have the 8:30 candle right here, and this is where we have CPI. Now CPI did something actually very funny, and now that I'm thinking about this video actually might be a little bit long because there was a lot of discrepancies going into today's price action. A lot of discrepancies. First, we had a six sisters, and the meaning of the six sister is that one of the correlated assets is moving in complete opposite direction compared to the other assets. So jumping onto a different chart very briefly to get a grasp of what I'm talking about. When we're looking at these charts, these are our correlated assets. We have NQ in the middle, we have ES on the right, and then we have YM on the left hand side. What do we take a notice to? So we have 9:30 opening right here. The candle is anchored for the 9:30 opening. What we take a notice to is that YM delivers immediately towards sell side. NQ is stagnant, ES is also stagnant. The assets are not moving in tandem. The assets are not moving in sync. They're not following suit with each other. They're correlated assets and they're supposed to be moving in suit with each other. And what this does is pose very, very difficult price action to navigate when you are looking to navigate. And what is required? And what is required when we end up seeing that one of the assets are sick is patience. Do not do anything. Quite literally, do not try to even engage with price action because it's going to invite these type of conditions. That's all it's ever going to do. It's going to invite these type of conditions. So one of the assets are sick, and that is one discrepancy. The next discrepancy that we ended up having during today's price action would be between the NQ chart and the MNQ chart. So taking a look at the chart, we have NQ on the left and then we have the MNQ contract on the right. What we take a notice to is that the 830 candle on the NQ chart is lower than the 815 candle on the MNQ chart. This is a discrepancy. So it looks like this. These are the exact same asset that we're looking at. We're observing the exact same asset. Simply one is micro and one is E-mini. But we're having a discrepancy between the two. This, again, is inviting for very, very poor conditions. And then an even larger discrepancy comes into play when we have the 830 candle being engaged with on the MNQ chart, but the 830 candle is not engaged with on the NQ chart. Once again, another discrepancy inviting for very, very poor conditions during the AM session. All that is required from one is to simply be patient until a sense of clarity is arrived upon. And how do we arrive at a sense of clarity when we can't find that clarity observing price? Price is being manipulated, price is being distorted very heavily. So what do we rely on? We rely on time because time cannot be manipulated. Time can be distorted, but it cannot be manipulated. And when these assets end up moving back in sync is when they both engage with the 930 candle high. And this is when the assets end up moving back in sync. So we end up seeing the 930 high being engaged with on the MNQ contract, and we end up seeing the 930 high being engaged with on the NQ contract. And then we can say to ourselves, okay, the assets have now moved back in sync, because we also take a notice to the fact that the 830 high was also engaged with on the NQ contract. So I'm briefly just going to run through this because there's really not much to actually say here. We're just doing a whole lot of nothing. So we have that 830 CPI candle, and also another thing is the fact that not only do we have the cracking correlation with the exact same asset being the NQ contract and the MNQ, but also ES as well. So ES, the 830 candle, took the 829 candle, NQ failed to follow suit. So after CPI, we fall into a phase of consolidation, and this is ahead of our 930 opening. Ahead of 930 opening, we establish a cracking correlation for that buy side delivery motion, anchoring our standard deviation from this low all the way up to this high. And we have that -2, -2.5 for where price action ends up falling short of the data high that resides right here. And all we're simply doing here is engineering orders under the data high in respective to the NQ contract. So we end up having the first presentation being printed right here. And what do we take a notice to? The fact that the first presentation, for one, was inversed, not utilized as support. It was then reclaimed, and then we return back into it. And we have the accumulation of orders residing in the first presentation of the AM session. Now, before we move on from the first presentation, there are a lot of things that is going on that I've stated within price action that can give one an indication that we're going to see poor price action like this. So we know that price operates under an algorithm that runs under a rules-based system. And within this system, there are certain principles that price follows. In terms of, if I tell you that a vehicle is supposed to begin moving at a speed of 80 to 100 miles per hour the moment it shifts into gear 5, that is a system in place for that vehicle, and that is a principle that it has to follow. Now, if we end up shifting into gear 5 and we don't end up operating or moving at a speed of 80 to 100 miles per hour, there is something wrong. The vehicle has shifted into gear 5 from gear 3, skipping gear 4. Now, to be honest, I have no clue where I'm going with this analogy, but in my head, before I started speaking, it made sense. But this is essentially what I'm trying to say is that with price action, there's principles, there's a system that need to be followed. And when these principles aren't followed, it's simply just an indication for one to take a step back. Now, a lot of these are just signatures in price action. We know that at a point of inception, once a change in stay in delivery has been established and engaged with, we should see a low resistance liquidity run away from our point of inception. Price should be very eager to run away. For example, right here, we have a point of inception, change in stay in delivery, engagement, we run, we leave instantaneously. We don't return back down to it. Again, here, we have a point of inception, change in stay in delivery, we engage with it, we run, we leave instantaneously. And here we don't even engage with the bodies of the change in state. And we don't even engage with this imbalance right here, which is being utilized as a breakaway gap, which we will touch on. But there's a lot of signatures that can be used in order to give you an indication of the type of price action that we're going to see. We have already gone over what we were looking at on the 15-minute. We've already gone over what we were paying attention to between the discrepancies of NQ and MNQ. And these are all indications that can give you a sense of direction in terms of, okay, this is how I'm going to look to navigate this session. This is what I'm going to look to expect. Now, I am currently creating and in the making of a series which I call Card Counting Series, which is going to be a complete rundown and breakthrough as to how to perceive price action through an algorithmic lens, as well as how to engage with price action efficiently from an algorithmic standpoint. But carrying on, we have the accumulation of orders at the first presented fair value gap of the AM session, deliverance down towards sell side. We have the 10 a.m. opening right here, and this is very nice. This point of inception was nice. I simply just didn't take it because it didn't meet all of the requirements. Yes, we have this Kraken correlation, but we don't have a PD array that we're engaging with. So we have the Kraken correlation, we have 10 a.m. no high, we have a clear drawn liquidity right here, as well as the fact that we have the engineering of orders at the data highs, and then we also have this external high that resides right here. The only reason why I wasn't opting to take this is because of the price action I was seeing to the left hand side. It's because of the price action I was seeing on the 15-minute chart, as well as the fact that I was leaning towards shorts for the day. Initially, what I would have preferred to see, again, in an ideal world, 9:30 open, immediate deliverance towards buy side, engaging with these highs, point of inception occurring, smooth run down towards sell side to engage with TGIF. That is not what ends up occurring today. So we end up having this point of inception, change in stay in delivery right here, engagement with that order block, deliverance up towards buy side, engaging with that 10 a.m. opening, and delivering up towards these highs. Now, coming back to that rules-based system, coming back to the principles, what is this? This is a TLP. We should run through this in a very low resistance manner. Price action should be very willing. It should be eager to completely displace through all of these highs. We don't see that. We end up seeing price action being very lethargic as we are approaching these highs. This is a warning sign. So what is going on? We're not following the principles that we know the algorithm should be following. But we do end up coming and engaging with all of these highs in that lethargic manner. We end up rejecting the high right here, as well as leaving this external high as well and returning back down into the range, engaging with the equilibrium of this given range. So from this low all the way up to this high, you have your equilibrium, and then you have your OTE that resides right here. And then you have this pool of sell side, which would be your M5 BISI. But we have that deliverance back down, engaging with this inversion again, and then we have that deliverance up towards the buy side. Again, very lethargic price action. It's not willing to go anywhere. We've just reaccumulated orders at this low, which would be the high of your M5 BISI, but we don't have a clean inversion. We don't have a willingness to deliver. We don't have efficient price action being shown to us. Right here, we have an order block formation. So we have a Kraken correlation, and then we have a series of down close candles, series of up close candles. For one, the closure above this candle isn't really as enticing, but we do have the candle trading above this high. And then we have the return back into this order block. What do we take a notice to? We're delivering under the mean threshold of the order block. This isn't a signature of price action willing to run in one direction. This isn't a signature of one-sided price action. This isn't a signature of price action showing willingness to go in that direction. So yeah, moving on away from that, we have that deliverance up towards buy side, very lethargic manner. And now I took one short position before engaging with this external high because we ended up forming a Kraken correlation with this high, and we ended up presenting the signatures on the lower time frame. So if we jump into the 15-second, what I took a notice of would be the fact that, for one, we engage with the range high, and then we have a Kraken correlation right there, and then we end up having another internal Kraken correlation that resides right here, and then we have that inversion. I simply just market executed right off of the inversion, and once again, what do we take a notice of? We're not seeing the signatures that I would like to see. Price action should not be coming back and reclaiming the imbalance instantaneously, being this bullish imbalance right here. We end up coming up, closing above it, then we end up forming another Kraken correlation, then we have the change in sustained delivery. looking at this, my stop loss would have been permitted to be moved to this high, but ultimately it didn't matter. It's quite literally like 2 points, 1 point difference, but we have this change in sustained delivery. The overall fact is that once we return into this order block, we should have seen price action deliver. It should fall right out of bed and continue that sell side deliverance, but we end up seeing lethargic price action. It doesn't want to move. It doesn't want to go anywhere. And as we're doing this, we're simply just engineering sell side. So that was the premise for the very first trade that we had taken, and that ended up taking us out. And when it took us out, I'm still with the idea of taking shorts, because then we end up forming another cracking correlation. So we end up engaging with this external high right here, and then after engaging with it, we form an imbalance, and then we have the inversion of this imbalance. The moment we had this, market executed into the trade, because this was a lot more cleaner structure than we had on this trade right here. And the standard deviation projected for a whole lot further, because the standard deviation on the first trade, this high all the way down to this low, is only projecting, the terminus is only projecting for right here. I'm trying to frame a 10 a.m. power of 3, because this isn't a sufficient low for our 10 a.m. power of 3. We aren't engaging with any higher time frame PD array. We aren't engaging with anything of true caliber. The only thing that we engaged with would be the previous day high, as well as the equilibrium of our previous settlement. So you grab the 9:30 opening all the way down to our previous settlement, and we end up seeing the equilibrium coming in right here. That was all we were engaging with. It's not sufficient enough for me to say, okay, this is going to be our 10 a.m. low, because I was going into the day with the premise that, are we going to fade the previous month high? Of course, I'm not going to marry this bias. I'm going to look for things that align with an idea I had in mind, as well as the fact that when we come, we reaccumulate orders. This is a sufficient reaccumulation of orders. We deliver down into a discount of this range. The deliverance back up, lethargic. It's unwilling. We're simply engineering sell side. The reaccumulation, redistribution of a market maker model, the second stage should be fast. It should be fast. If there is an objective that we need to complete, being the terminus, we should get there in a rather quick manner. We don't see this here. So we have the second trade we end up taking, market executed right on this candle, and then we have the change in sustained delivery. And what we also have is the inversion of this BISI right here. A lot of signatures are being placed, and a lot of willingness is being placed here for price action to deliver down towards sell side. The inversion of this candle, then we have a breakaway gap, and then we have the inversion of this imbalance right here. A breakaway gap is essentially used to take price action out of the lethargic price action it was initially in. It's used to get price action to run away from where it currently is, and you normally see it when we have price action like this and we're changing the motion, because we need a form of volatility for us to begin delivering in a low resistance manner, because that is what we see here as well. We have a breakaway gap. We need a form of volatility for us to completely disregard the type of deliverance we were initially having to then turn into low resistance. So that's what we have here. We have the breakaway gap inviting for low resistance liquidity run conditions, and then we have that deliverance down towards sell side. Standard deviation projection, projecting for all of this segment of price action right here, and then we have the -4, -4.5 projecting for the range low that resided right here, which was very nice. Now, taking a look at the last position that we ended up taking during the PM session. So what we end up having is we have the lunch session starting right here. We end up forming the lunch high, and then we have the lunch low forming right here. Lunch delivering in the manner that you'd expect it to, not showing a willingness to go anywhere. We're engineering buy side. That's what we take a notice to. Right here, we're engineering buy side. So highs are being stacked up on top of each other. And when I came and I started observing this price action, what I noticed is the fact that, okay, 1300 opens, and what we notice is that the 1300 candle ends up forming a devil's mark. We don't have a sufficient high on this 1300 candle, and the 1300 candle will be the opening of your hour one, and it is ahead of our 1330 candle, which would be your New York PM session, the start of it. So we end up having price action delivering down towards sell side, and then we end up having the distortion of time and price here, because during this segment of price action, it's time. It's during the window that we're normally looking to see price action form a point of inception at. So right here, so all of the price action within this line right here, it's time. We can form a point of inception, but we don't end up doing that. And if we really want to be exact, because this time window that we have, it's given a grace period to the macros of 5 minutes on each side. So the time window that you're really looking at would be this time window right here. So being the 10-2 to the 10 past mark. And this is where the price distortion ends up occurring at. Now I say price distortion and time distortion because price distortion will occur when it's time, and price is simply just doing nothing. It's just essentially charging up the bar for a low resistance run. But It's also a time distortion here because we're waiting for a specific time, because it's not time yet. The time we're waiting for is 13:30, which is our New York PM session opening. So it's time and price distortion that is occurring right here. 13:30 comes, and then we have that cracking correlation with the New York lunch low with ES, which is very nice. And then we end up having a 15-second change in stay in delivery that resides right here. Now, like I mentioned on the 15-minute chart when we were observing this, I was saying that this candle closes bullish. This candle closes bearish, but on the lower time frames, the candle would have closed bullish. We would have had that sequence of up close candles and down close candles, which is what we end up having on the M1, sequence of up close candles, sequence of down close candles. And we would have this here as well, and it simply just be on a lower time frame, which is why we executed off of the 15-second. What we end up having is a sequence of down close candles and a sequence of up close candles for our change in stay in delivery that resides right here. So sequence of down close candles, sequence of up close candles, and then we execute off of the change in stay in delivery for that buy side delivery motion that we end up having. I end up executing off of the 15-second, and in one of my earlier executions, trade analysis, I was mentioning how you want to see the time frames unravel themselves out as if you're looking at concentric circles, and the very center circle would be the lowest time frame you're paying attention to. And as we roll out, forming bigger circles, we want to see those time frames following suit. So what you would have wanted to see here would be a change in state being provided here on the M1, but we don't end up seeing that. What price action ends up doing is returning back down, delivering under the 13:30 candle, which is the opening of our New York PM session, and this is also a rejection block that resides right here. And simply all I was targeting for this position would have been the -2, -2.5, because of the conditions that we had overall for the day. When we have conditions like this for the day, I'm not looking to hit home runs in terms of looking for a full terminus pull. Yes, price action may project for that full terminus pull. Yes, price action may deliver there, but it's going to do this in this manner. Looking for price action to just engage with the -2, -2.5 is always optimal in terms of either taking partials or just looking to collapse the trade there entirely. And then the last thing I'm going to point a note to on this chart would be the fact that we end up having a 15-second change in stay in delivery, like I mentioned. So if we come and we project the 15-second change in state, what we end up taking a notice to is the fact that the change in state overlaps with our previous element. And once again, this is simply just algorithmic. It's not random. And once you begin to start seeing these occurrences happen, it's very nice. It's very nice and smooth. As well as the fact that with this change in stay in delivery right here, we have this very small imbalance that resides here, which was formed after we engaged with the rejection block and then had a order block formation that resides right here for that buy side delivery motion.